Hello and welcome to Module 5 of the Forex Complete Solution Basic Training course on Intermarket Analysis. The definition of intermarket analysis is the analysis of more than one related security or financial market to assess the strength or weakness of the security or financial market being considered. Instead of looking at the financial markets on an individual basis, this type of analysis looks at several strongly correlated markets or asset classes such as Forex, stocks, bonds and commodities. Intermarket analysis simply expands on looking at each individual market or asset class in isolation by also looking at other markets that have a strong relationship to the market being considered. In the foundation course, we have discussed the four capital markets on an individual basis: the bond, the commodity, the Forex and the equity markets. I will now take a bilateral look at the relationships between these markets. So no matter what security you are trading, you need to keep an eye on how the other securities are relating to each other. I will begin with one of the most important intermarket relationships, the commodity and bond relationship. It is important if you can establish a link between the commodity and bond market. Then you can also find a link between the commodity markets and the equity markets, because the equity markets are influenced by a large extent by bond prices. The dollar also influences the bond and equity markets, but the dollar's influence on the equity and bond markets comes through the commodity sector. So the key relationship that links all four sectors together is the link between bonds and commodities. The reason commodity markets are so important is because of their role as a leading indicator of inflation. Inflation, put simply, is the overall upward price movement of goods and services in an economy. Things become more expensive in real terms and the value of money is eroded. Bonds and commodities tell us a huge amount about inflation and deflation. They are the main markets used by central banks to gauge economic activity and on which interest rate decisions are made. For a Forex trader, the main reason to look at the bond and commodity markets is their direct link to inflation and future inflation expectations. For example, if the Federal Reserve raises interest rates, this will impact the US dollar and the various currencies that trade against the US dollar. So it is imperative that you do not just look at the currency pair that you are trading. You need to have a broader view of the marketplace. Now I'm just going to bring up a chart here. Okay, this is gold. I'm just going to bring up a chart of gold and explain why I am doing that. Okay, a popular commodity to trade is gold, and gold is the ultimate safe haven asset when investors are seeking security in uncertain times. If the price of gold is rising, then you may see a flow of money out of the riskier asset classes such as equities. It goes back to the basic premise of economic supply and demand. If a commodity is in demand, the price will rise. Again, look at both technical and fundamental reasons for the price rise. So we're going to look at the price of gold back from February to March 2014. Okay, so gold from December 2013 to March 2014 rose after a massive sell-off. So we can see that the price selling off in gold down here, and then it bottoms out and we get a little spike up in gold. Okay, so from a geopolitical point of view, we had the Ukraine-Russian conflict. Okay, this paved the way for a safe haven commodity such as gold to rise in price. And we can view this technically by looking at our historical price of gold. So we can look back from January, February and up to March when the Ukraine-Russian conflict was at its height, and we can see the safe haven fleet of gold. So you can see the price of gold rising, and it topped out on the 10th of March there. It topped out in March, mid-March in 2014. Okay, so where prices peaked. And in March 2014, the riskier asset classes, i.e. equities, sold off. Okay, and we can see it, the direct correlation, the inverse correlation now between the equity selling off. So here we have the price of gold rising, and now I'll pull up a equity. We pull up the German DAX 30, and this is a weekly chart of the German DAX 30, and we can go back to the same moment in time there. Here we have it in March. It's exactly the week 10th of March. So we can see the market is rising. Okay, but then you're coming into January, February, and in March again, as gold is rising, we had a brief sell-off for a couple of months there in equities. We can see it there. It bottomed out in the week beginning the 10th of March. So you can see the direct inverse correlation between equity selling off and the price going up. Okay, so we can see that in March 2014 that the DAX sold off roughly 850 points during the conflict. Now, the reason the equity market sold off was not just because of the conflict itself, but it was also to do with the economic sanctions imposed on Russia by the European Union. This affected Russia's banking, oil and defence sectors, amongst others. So why did the DAX 30 sell off? Well, because Germany and Russia are major trading partners, and the economic sanctions can be seen in the sell-off in equities. Okay, so the Russians, the Germans, and the Germans were big trading partners. So you can see why equities fell off, not just because of the conflict, but because of the economic sanctions. So again, here's our intermarket analysis. You're technically looking at the market selling off. You're seeing your support and resistance points. Here we can see the market in an uptrend, as we've discussed in previous modules. So the market is in an uptrend. We can see our uptrend here. For our previous module, we had our 3 touches to confirm an uptrend, 1, 2, and 3. But briefly, the market did sell off, even though it was in an uptrend. So it briefly sold off, and the reason why was because of the conflict. So from an intermarket analysis, you're looking at 2 markets there. You're seeing gold going up and you're seeing the equities going down. So that's a classic example of intermarket analysis. So from an intermarket analysis, we can see for ourselves from both a technical and fundamental point of view how and why gold and equities traded inversely during this period. Now, be aware that virtually all commodities are traded in the currency of first reserve, which is the United States dollar. If the United States dollar is weakening, then commodity prices in general will rise. And if the US dollar is strengthening, then commodity prices are likely to fall. This takes us back to inflation, because if the US dollar is weak, then commodity prices tend to rise, making them more expensive. Hence, we can see the drive of inflation back into the economy. And I want to make you aware of these relationships, because as traders, 90% of our work is preparation and only 10% is trading. Okay, so before we take any trade, we must have a broad view of the markets as a whole and trade the correct trend. We must not just look at our own instrument in 1 or 2 time frames and trade off some technical indicators. We need to fully prepare each trade, and this is the true path to sustained wealth. Okay, so the discipline to forever be a student of the markets and to adapt to whatever market conditions are prevalent at that exact time. Okay, so remember, we need to take a broad view of the markets. By one instrument, I mean, if you're trading Forex and you're just trading the Euro USD or the USD JPY, you need to take a broader view of the markets as a whole. You can't just look at the Euro USD in 1 or 2 time frames and think you're going to trade long-term profitably. You have to take a broad view of the markets, okay? We'll now focus on the relationship between bonds and equities, okay? And I'm going to pull up our tool here for our bonds. Okay, so a simple way to view the relationship between equities and bonds is one of risk for investors and traders. If capital is flowing out of equities and into bonds, then traders and investors are fearful, and as with gold, are looking for a safe haven asset class to invest in. Equities are seen as a riskier asset class opposed to bonds. Okay, so we can pull up our Euro bond and we can show you again in real time the flight to safety. So I'm going to pull up our chart here of the Euro bond. This is a bond, and here we have it, and we go back to a monthly time frame, and again we can go, actually you can go to a weekly time frame, and again when we go back to March in 2014, you can see people. There we have it. It's just around from early March up to we can see the start of an uptrend. So again, the Russian-Ukraine crisis was starting, and people were taking a position in bonds. Okay, and it spiked quite high there, coming into April. So you can see it's a safe haven asset where people were looking to invest during that Ukraine and Russia crisis. Okay, so this is a simple way to move into a safe haven asset. Okay, now, the release of bad economic data, such as a lower gross domestic product figure, this can also impact where the money can flow to. Okay, now we have short-term bonds, and I'll use the US bonds because these are a highly tradable bond on the financial market. So we have short-term bonds in the US. These are T-bills. Okay, you have medium-term bonds, i.e. the US T-notes, or the long-term bonds, i.e. US Treasury T-bonds. Okay, and these can be from a month up to 30 years. Okay, so a flight to safety may be just that, and investors will move funds for the short term into short-term T-bills. Okay, and we can see that again here. I can pull up our bonds. By the way, this website is called investing.com, and for any trader, it's an invaluable tool to use. It has prices on everything here. You have your indices, your commodities, your forex, and your bonds. Okay, so we were looking at the US T-bills. Okay, so investors may view the bad economic data as a short-term pullback on equities, and will decide to return into the equity markets when they see buyers returning. So again, we can go to our investing.com, and where are we getting these prices? We can go to bonds. We can go to world government bonds down here. Okay, now I'll bring up all the bonds. Investing.com will have every piece of financial data that you will need, and it's all for free. Okay, so we pull that up again, go to markets, go down to bonds. Okay, just go to markets and pull up bonds, and go to world government bonds. You should get it now. We're going to be looking at the American bonds, so we can see the live prices and the world government bonds. So you're going to bonds, go to world government bonds, and click, and it will bring up our bond prices. So there's all the bond markets we can look at. So again, we're looking for the US bond market. So we can just scroll down, and we look at these again. We'll be looking at a couple of bonds later in the module. We'll be pulling up some Japanese bonds, but for the moment we are looking at the US bonds. So we just scroll down, and we're looking at historic prices here, just to show you how they traded. There we have the UK, and here we have it. Okay, so there's the US T bonds. Okay, so a flight to safety may be just that, and investors will move funds for the short term into short-term T bills. Okay, so investors may view bad economic data, such as a bad GDP, as a short-term pullback, and you can see the yield here. So we're looking at the short term up to 30 years. So that's a 1-year bond all the way up to a 30-year, and you can see. If we're looking to see how people are trading it, and is the money going into a bond, well, it's a very simple way we can do this. Okay, we go to historical data, and again, we've all the data here, and it gives us up to date, up to the minute. Okay, no matter what you're trading, investing.com will have everything for you. So how do we know that people are coming in and out of UST bonds? Well, here's our volume. Okay, we have our volume there, and you can see the percentage change in people coming in and out. So again, this is a 1 year or a 1 month bond. Okay, so if we're looking for a short-term flight to safety, we have it here, and you can see the percentages of people. You have your yield, and you have your price, and you have the percentage change. So that's the T bonds. For people who are looking to trade that in the short term, you can see the volumes going in, and you can see the equity markets may be falling off. So this is known as a risk off trade. Okay, so traders or investors are looking to take capital, i.e. cash, out of the riskier asset classes, and the stock market, i.e. equities, would be viewed as a riskier asset class, whereas bonds, some bonds would be a guaranteed source of a guaranteed investment. So investors will put their money into a bond. So you can see in real time where people are putting their money. Okay, and risk on, we've discussed risk off. Risk on is when investors are happy to reinvest their money in the riskier asset classes in the hope of higher returns. Okay, and then you can see the volumes returning, and you can see, for instance, here's the USD 30. This is the Dow Jones 30. And again, if you're looking for volumes, go to investing.com, pull up whatever you're looking to trade. So this is the US 30, which is the Dow Jones 30, and go to historical data. Okay, and here's our volume. And volume tells you how much is coming in and out of the market. So again, we look at the US 30. Let me pull it up now. And we go to historical data and double click historical data. And we can see the volume there. So we can see the percentage change in the volume. Okay, and you see the average volume. So you can see if the markets are buying and selling off. And as we can see from our charts at the moment, we pull up the we'll pull up the US 30. We can pull up the chart here. So there's our volumes. As you can see the volume change day in, day out. And then we can pull up our chart to see if the market is buying or selling off. And there we have our chart. And to change it to our candlestick chart, we just click candlestick chart. And to change our time frame up here, you've got from 5 minutes all the way up to 1 month. So we can put maybe, if we look at 1 month information on the Dow Jones, and you can see it there again. It's an uptrend. Okay, so that's what we're looking at. So you can see that's our risk on and our risk off trade. And I will now look at the relationship between bonds and the forex market. Okay, so the two things that will affect the value of a currency in relation to bonds are bond yields and bond spreads. Okay, bond spreads are generally a lower yielding investment. Okay, so when compared to currencies, bonds are generally a lower yielding security as compared to currencies. Okay, so you'll have a lower return on your bond, but for the return you're getting, it's a safer asset class. Okay, currencies would be a lot more volatile than your bonds, especially the longer term bonds, the 5 and 10 years, and especially the 30 years. There'd be a lot less volatility on those financial assets. So as I've said before, investors usually purchase bonds in times of uncertainty. Okay, they're looking for a safe haven security. An example of how currency relates to a bond is the relationship between the US dollar and the 10-year T-note or Treasury note. Remember, the currency of the currency of a country and the country's bond price are tied to the interest rate of the country. If retail prices rise, there is a risk of inflation, which in turn may lead to an interest rate hike, which in turn leads to a higher bond yield. Higher bond yields tend to lead to a higher demand for the local currency, as forex investors exchange their currency for the local currency in order to buy the bonds of that country. Okay, so this increase in demand will lead to the rise in value of a currency, and hence the rising bond yields lead to a higher currency value, while falling yields will lead to a drop in the value. Okay, and we can see this now. I will bring up our bond. I should bring up one of the more popular is the US 10-year, okay? And we're going to look at the relationship between this and the USD to see how they trade in correlation with each other. So we just pull up our chart. Again, we can look, this is just a basic line chart, but if you want to look at your candlestick chart, put on your candlesticks and we can go to 1 week. So you can see how it's trading there, okay? And how does it trade with your Forex? Okay, so you're looking how is this going to trade? So you can see the chart there, and it's in a basic uptrend at the moment. It consolidated, it fell off a little, consolidated, and now it's back into a bull trend. So we can see how that correlates with our Forex markets, i.e. our US dollar. So you just click on your Forex, and we can pull up our USD Canadian. You have all your currency pairs here in real time that you can look at. So we're looking at the correlation between the prices of the US 10-year and the USD Canadian. So you can see it's in an uptrend too. The market's buying it up. So you can see the correlation there in real time between those two markets. And this is intermarket analysis in real time and showing you how it works. So using these two charts, we can see a positive correlation between the USD Canadian and the 10-year yield. Okay, this highlights the relationship between the US 10-year note and the US dollar. And another link between bonds and currencies are bond spreads. Okay, bond spreads simply refer to the difference in bond yields in the two countries in the currency pair being traded, i.e. USD JPY or the US dollar Japanese yen. The countries whose yields are compared are in spreads and are those that are found in the Forex market. Okay, this brings us on to the carry trade. Okay, and a carry trade is simply a Forex strategy where the trader seeks to gain from the differential in bond yields of two currencies paired together. Now, the best gains generally come from a currency with a relatively high bond yield traded with another currency with a lower bond yield. And a historical example of a carry trade was during the 2006-2007 when Japanese bond yields were at an all-time low around 0.5%, and Australia's bond yields were at close to an all-time high at 8.25% at one point. So a Forex trader trading the Aussie JPY or the Aussie Japanese yen made huge profits during that period. So a prudent Forex trader will seek out these price differentials when choosing which currency pair to trade. So traders can use these bond resources to trade currencies. And there, as I say, there are several websites to get these prices and yield prices. But one of the best here is investing.com, which provides live prices and has a wealth of information for traders and investors. So again, you may need to listen to this module one or two times to get an indication of how the markets correlate and trade inversely. And one thing I will say, that these relationships do break down, okay? Nothing in trading is going to be 100% scientific proof, okay? Relationships do break down from time to time for various reasons. And this is one of the main reasons why your preparation is so important for consistent wealth in the markets. As I say, when I said trading is only, the actual trading should be only 10%, because once you've done your homework and your preparation, you have built your trading plan, and in future modules we'll be showing you how to build your trading plan. But once that is in place, you're waiting on your price and you trade your price. So as an actual trader, when you're taking your trades, that should only be 10% of your time. The rest of the time is spent analyzing both your fundamentals and your technicals. And that is up to you. So we have, whether you're a novice trader or you want to be a full-time trader, a full-time professional trader, all the information is out there. We all have the same information, okay? And we're trading off the same information. So if you go to website investing.com, all your information is here. You have your indices, you have your commodities, you have your Forex, and you have your bonds. And your job is to just decipher how these markets correlate with each other and how they correlate, as how some will move together and some will move inversely. They'll move in separate ways. So you have to find out why and how that works. And that is basically intermarket analysis. And it can change over time. Right now in Europe, you have the euro USD. Okay, so the euro US dollar is selling off, and the reason for that right now is because the ECB, the European Central Bank, has a bond buying stimulus program. So the ECB, the European Central Bank, is buying up bonds. Okay, so that's supporting the equity markets. So the ECB wants to have a lower euro. So that helps with exporting goods, okay, and that's why they want a lower euro. And one of the ways they are doing this, they are supporting equities by buying their bonds up, which is called quantitative easing. So that's what's happening right now. So your job is to keep up to date constantly with the markets. As I say, the markets constantly change. So even if you go away on holidays for a week or two and you come back, the main narrative of the market may have changed, and it's your job to do your research and get back up to speed before you take any trade. Okay, as I say, preparation is everything. You don't just put on your laptop and open up your broker account first thing in the morning and just look at one chart and decide to go long or short. We're looking at the markets as an overall, and this is where you get your real wealth. The idea is to trade less, but to trade more intelligently, okay? And it's all here for us, and it's anybody can do this, believe me. The people who won't make money in the markets are the people who will not take the time to learn what the markets are about. Okay, and it's all there for us. So as we discussed here with our intermarket analysis, it's just another tool for you to use to help you get on the right side of the markets. Okay, so this is the main thing I want to drill home with you here on our intermarket analysis course, is that the markets do not trade in isolation. Each market will trade inversely or will correlate with another market, and over time you will see you will see how these relationships work out. Okay, so you need to see how bonds work, how commodities work, how forex works, and how forex pair will work or trade if there's inflation data coming out. Okay, right now you have a zero interest rate policy in America, and you have done for nearly a decade, and now the Federal Reserve are looking to raise interest rates. So you'll need to know that the Federal Reserve are looking to raise interest rates, and you will need to know what effect this will have on the US dollar, because if you're trading the US dollar against any currency pair, you're going to need to have this information, and all this information is here for us. Okay, and we can go to we'll be looking at further, we'll be doing further courses in fundamentals, and we'll be looking at a further module again on the economic calendar. So this module again was just to break down the intermarket relationships and how they will work. Okay, so that was our module on intermarket analysis. And our main aim again was to show you that no market moves in isolation, and it is our job as successful traders to be aware of how each market is impacting on our own trade. Okay, so thank you for taking the time to listen to this module, and I hope you will enjoy module 6, which will be trading trends and ranges. So thank you very much, and goodbye.